Modern financial markets appear to be in constant motion, rejecting predictability at every turn. Yet within that seeming chaos, there exists a rhythm, a recurring structure that can be observed, understood, and perhaps even anticipated. This study seeks to capture that flow using the language of quantum physics and machine learning. Rooted in the Feynman-inspired principle of least action, this project is a comprehensive attempt to unify macroeconomic indicators and asset prices into a predictive and interpretable forecasting framework. To begin, we focused on rigorous data preparation. We first collected 20 years of macroeconomic indicators from the public FRED API provided by the Federal Reserve. This dataset includes 45 key variables, ranging from GDP and unemployment to inflation, oil prices, interest rates, and exchange rates. To ensure performance, we parallelized the download process and implemented a local caching system to avoid redundant requests on subsequent runs. Next, we retrieved historical stock price data for all listed companies on NASDAQ and the New York Stock Exchange using the Y-Finance API. Ticker information was gathered via FTP, and stock data retrieval was optimized through concurrent batch processing. Given the volume of assets, parallel execution significantly reduced runtime. All daily data was then resampled to monthly frequency and standardized using the Z-score method. Specifically, we subtracted the 12-month rolling mean and divided by the rolling standard deviation to ensure comparability across all variables, regardless of their scale or units. Based on this refined dataset, we computed the least action path of asset prices. Price differences were squared to define an action term, which was then accumulated over time. The cumulative action was transformed using a complex exponential function, yielding a market phase representation phi equals express. This formulation compresses market dynamics into a single phase value, much like how wave functions in quantum mechanics encode energy flows. However, price alone is not sufficient to understand markets. To model the evolving economic context, we trained a recurrent neural network, specifically an LSTM, to generate 16-dimensional embedding vectors from rolling 5-month windows of economic data. These embeddings serve as compressed representations of the underlying economic environment at each time point. We then integrated all features, phase changes, phase curvature, economic embeddings, rolling means and standard deviations, into a unified dataset for supervised learning. The objective was binary classification, to predict whether an asset's price would rise or fall in the next month. We trained an XGBoost classifier on this data. XGBoost, a tree-based ensemble method, was chosen for its strong performance in structured prediction tasks and its ability to capture nonlinear interactions among features. The dataset was split into a 70-30 train test ratio, and the model was trained with 300 boosting rounds. After training, we evaluated the model's performance using precision, recall, and F1 score. Additionally, we visualized both the cumulative action and its rolling variance to better understand structural patterns in market behavior. We also explored short-selling strategies by identifying time points where the market phase turned negative. These periods, interpreted as energy instability, were used to select stocks with the lowest probability of price increases as short candidates. Finally, we clustered the economic embedding vectors using PCA and K-means, yielding 4 distinct macroeconomic regimes. These regimes, interpreted as expansion, crisis, recovery, and overheating, were incorporated into the feature set, allowing the model to adapt its predictions based on prevailing economic conditions. Through this process, we aimed not merely to forecast prices, but to model financial markets as dynamic systems governed by energy, context, and temporal structure. This project represents an interdisciplinary convergence of economics, physics, and artificial intelligence, offering new insights into how we understand and anticipate market behavior. This has been a research presentation by Covenant. Thank you for your attention.